Okay, go back to the PowerPoint here. So that was horizontal analysis. The next one we're going to look at is vertical analysis. So here we're going to do this per statement. So for example, on the income statement, we're going to divide everything by revenues to get a % of revenue. On the balance sheet, we'll divide by assets to get a % of assets. Okay. So on our balance sheet, to do what we call a vertical analysis, we're going to take every account and divide by total assets. So on this first one, we would take current assets of $550,000 divided by total assets of $1,139,500 to get that current assets make up 48.3% of total assets. Okay. So on a vertical analysis, on your income or balance sheet, you're always dividing by total assets. Technically down here, they say it's total liabilities and stockholders' equity, but those equal, right? So really, you can just divide by total assets all the way. Okay, so everything is a percentage. We just look at assets as a % of total assets, and then liabilities and equity as a percentage of total liabilities and equity. So you're just dividing by that same number every time, all the way down. So again, this tells us, of our total assets, property, plant, and equipment make up 39% of total assets, which is a slight increase. See, they still have the comparative there, and they've done both years. So we can see that's a slight increase from last year. And then current liabilities are 18.4%, which is a slight decrease from last year. Long-term liabilities is 8.8%, which is a significant decrease, 50% decrease. So again, you can kind of see, it just gives us a different way of looking at it. We saw on the comparative, the horizontal analysis, the change in cash, the change in dollars. Now we're looking at % of totals here. Common stock increased from 40.6% to 43.9%, even though it's the same number. Okay? Because your total liability and equity situation is changing. So it's just something you'd look at in tandem with that horizontal analysis to really see, again, the big picture. So again, when we're doing analysis, we're going to look at vertical, horizontal, and all the ratio analysis to give us the whole picture of what's going on. So you can see all through, we've been getting little pieces. Now we're putting it all together. Okay. On the income statement, we would do the same thing. We're going to divide everything by sales or by total revenues, depending on what kind of company we are in. So, sales will always be 100% of itself. But we can see cost of goods sold in the base year was 68.3%, and it's 69.6%. So that's where I would look at, and our gross profit percentage went down a little bit. That's where I'd look at, our costs are rising. So that's one place we would want to look at a little bit. It's a small amount, but if that kept continuing for several years, that could become an issue. So that's kind of one thing we would flag and look at later. Same with, any increases or decreases in expenses and things like that. Net income, we saw it increase, but the % of sales did drop 0.3%. Again, a very small amount, but that's probably due to this increase in cost of goods sold. Okay. So again, it just gives us a different perspective, because when we were doing the horizontal analysis, we just saw that big increase in net income. We didn't see, the correlation that cost of goods sold is a higher percentage. Okay. So it just gives us a different perspective. Okay. So vertical analysis, again, when you're doing it on a balance sheet, you just divide everything by total assets. On the income statement, you divide by total sales or total revenues, depending on, obviously if we're a merchandising company, it would be sales. If we're a service industry, it'd be like revenue. So that's just the difference there. Okay, I think we'll talk about common size statements real quick too before we do an example. I don't think I have a practice on that one. Bless you.
Thank you.
But common size statements are often just used to compare.
So we can look at common size statements of one company to another within the same industry, and it gives us that comparison. Okay. So they're always just given in percentages. So we're just seeing, as you can see, you're seeing the vertical analysis comparison. So common size statements are vertical analysis. It's just showing the comparison between two companies. So we have Lincoln Company versus Madison Corporation. We can see the gross profit percentage is just slightly higher for Lincoln. Everything's pretty close though. We can see net income though. Notice it's a lower percent for Lincoln Company than Madison. And so we'd look at, well, why is that? And that's due to income from operations being a little lower, which we could trace back to operating expenses being a little higher. So again, it's good to compare to another company in the same industry, because then you have some comparison just beyond comparing to yourself. So it's like, are we meeting industry standards? So, we would probably want to pick a company that was profitable and solid to compare to, and not, someone that's tanking. We wouldn't want to, if we're retail, we don't want to compare ourselves to like Sears or Penny's. Bad idea. So, you don't want to make yourself look good. You want a true comparison to see where you're at. Okay. So that one's just looking, it's just a visual comparison. Okay. Any questions on that so far?
So with the vertical analysis, all that fun math and stuff, that's just with the current year itself, right? So if we were to look at the income statement and we wanted to calculate the previous years, we would use the previous year's total sales to calculate that, not the current.
Correct. Okay. Yeah. Like a lot of times, I think we do both, right? So good question. When we're doing vertical, like on this one, we'll have a current year and a previous year. But yes, when you're doing vertical analysis, you'll do vertical analysis on the current year and then do vertical analysis on the previous year. And then we can compare the two. That's what you're asking, right?
Yeah.
Okay, perfect. So here, if you go back into the practice, we'll look at vertical analysis on an income statement. So here we have revenues. This is the annual report of Speedway Motorsports. So this is showing all of their revenue. So we're going to divide everything to do vertical analysis on an income statement. We're going to divide everything by total revenues, okay, for the current year. So again, it's just doing math on these. So I just want to work down. So again, everything is going to be, for the current year, is going to be divided by total revenues at $490,160. Okay. So for example, admissions, what percent of admissions is admissions of total revenue? Very good, 23.7. So we're truly just taking admissions of 116,034 and dividing it by total revenues, 490,160. So of all of our revenues, admissions make up almost 24%. Okay. How about event-related revenue? What percent does event-related revenue make up of total revenues?
30.9.
Very good, 30.9. I'm imagining at a NASCAR event, that's probably a lot of beer. That explains like it being higher than admissions, right? So NASCAR broadcasting revenue, what percent would it be? 39.3. Good. Whoops, I'm putting it in the same one. That's not helping. 39.3%. And then we have other operating revenue makes up 6.1%. Okay. So out of all of our revenues, our broadcasting revenue, broadcasting to national television, cable television, makes up the biggest percentage, with event-related revenue being second. So they're selling merchandise and food and beer. So we add all that up, or you just divide revenues by itself, right? It should be 100%. But all that added up should add up to 100%. So that gives us a breakdown of our revenue. So when we have more than one revenue stream, we can see that breakdown. Okay, so it's a little different than when we're a merchandising company where we see sales minus cost of goods sold. And then we divide all of our expenses by total revenues as well. So the direct expense of events makes up 20.7%. 20.7%. NASCAR purse and sanction fees make up 25.1%. 25.1%. Other direct expenses, 3.9%. 3.9%. And then general and administrative, 37.4%. 37.4%. So our total operating expenses and other, so total expenses make up 87%. 87%. Income from continuing operations is 13%. So when I first see that, that seems kind of low, right? But again, we would want to compare it to an industry similar because margins and percentages are going to be different for all types of industries. You're going to see high margins in like, food and retail, but that's going to be, that might be standard. So that's just on the current year. And then in the second column, you're doing the same thing on the previous year. So everything in your second column or prior year gets divided by 506,205. Okay. So for admissions, 130,239 divided by 506,205, 25.7%. 25.7%. Again, we would just keep going. So event-related revenue is 32.3%. 32.3%. Broadcasting revenue is 36.7. 36.7. Other revenue is 5.3, 5.3, with again total revenues being 100%. So again, obviously we saw a slight decline from last year to this year in revenues. The makeup is just a little bit different, with the event-related revenue being a little higher and admissions being a little higher. So just a little different mix. And then expenses, we would start those. So direct expenses are 21%. 21%. Purse and sanction fees, 23.7. 23.7. Other direct is 4%. 4%. And general administrative is 47.7. So that's probably a pretty significant difference there. And notice this one, total expenses are actually 96.4%. 96.4%. So our income is only 3.6%. Okay. So that's where you really see a major difference here, right? When I look at that, my total revenues were actually greater in the previous year, but my expenses were also unproportionately greater. So my income from continuing operations actually was only 3.6 in the prior year and an increase to 13% in the current year. So I assume that last year we looked at this and we're like, oh crap, our income is 3.6% of our total revenues, and we made some changes, okay? And now it's up to 13%. So you can see why this is kind of important to look at this information and calculate that. Because just looking at, if we looked at just the change in income from operations, we wouldn't see why it changed, okay? So this, along with the comparative income statement, kind of gives us the whole picture. Any questions on vertical analysis? Okay. So it's just doing math, right? Just double check. When you're doing your test, just make sure you double check your math, do it twice. So. And if you get two different numbers, maybe do it a third time. That's usually me, right? I type it in like 5 times before I'm like, okay, that's the correct answer. That's bad. So on part B, we're just doing a little bit of analysis. It says, well, overall revenue, let's see, was it increased or decreased? Did overall revenue increase or decrease between the 2 years? Decreased. Good. We saw an overall revenue decrease between the 2 years. The overall mix of revenue sources did change somewhat. The NASCAR broadcasting revenue, did it increase or decrease? It increased, yeah, very good. Increased as a percent of total revenue by almost 3 percentage points. And let's see, while the percent of admissions revenue to total revenue increased or decreased? Decreased, good. Overall, it appears that income from continuing operations has significantly improved because of, is it aggressive cost cutting or a large increase in total revenue? Cost cutting, good. So again, when we look at these, we can see that it's not due to total revenue. We actually had a decrease in revenue, but we cut some major costs, and that's what allowed us to see that increase in income. Okay. Any questions on that one? Not too bad, right? I'm telling you guys, this is hopefully the easiest chapter, but don't treat it as such and overlook it. But it's not too bad. Do it. Yeah, it's really not too bad. All right. Well, the last part of the chapter is really just getting into the ratios. Did anyone not get, I think a couple people didn't get the handout. Okay. So you can probably tell I copied and pasted from the book. I'm citing my source now. I got this from the textbook. But they just do it, you know, so much very nicely and neatly. So again, we're breaking up the ratios into those 3 categories we talked about earlier. Hold on, actually.